For the last week, we've been gripped by the fear of bank failures. The shocking decline and fall of Silicon Valley Bank and Signature Bank had everyone worried that we might repeat the errors and disruptions in the bank runs that we saw during the Great Recession. Now, it didn't matter that back in 2008, what we had was a credit crisis with banks lending and borrowing against bogus real estate concepts. That wasn't the case, and it is not the case here at all. This time, we have a mismatch between what banks own and what depositors expect them to own. And those depositors can easily leave bad banks for better ones because the deposits might be too big to be insured by the FDIC. Of course, you can flee. A worried depositor can flee with a keystroke, particularly a worried depositor who needs money. We were shocked by how quickly Silicon Valley Bank collapsed, but when you have a handful of huge depositors in the same industry who constantly talk to each other, and it leaks to social media, it's no mystery that the banks are gone or if they all decide to bolt at once. And it is terrifying to see a stock go from 267 to zero in less than 2 days. That's what happened to Silicon Valley Bank. It's even more frightening when another bank goes from 70 to zero over the course of a weekend. That's what happened to Signature, which had a similarly concentrated deposit base, except it was more crypto-oriented. Oh, then Credit Suisse, a bank we've been worried about for ages, had already seen its stock roll down to $2. Then you wake up the next morning and sure, it's worth half that. And it's merged with UBS at the urging of the Swiss government. A lot of bank debt wiped out before common stock. So when we see another bank, say First Republic, experiencing similar deposit departures, it's natural to assume that that stock's also going to zero, even if it was in the 120s just over 2 weeks ago, because that 120 price hadn't have been wrong, correct? That's certainly what people thought as the stock plunged from $34 last Thursday to $12 yesterday, even as it rallied 3.5 points today, although, again, it's selling off after the close. Which brings us to the current state of play as of, well, let's say, last night and today. See, we learned that Treasury Secretary Janet Yellen has had enough, and she has said that deposits will be protected if that's what they have to do. Now, we don't have it written in stone. It's not like anything that we can take to the bank, so to speak. But let me see. It does say that we got to start being more positive, does it? The big issue in First Republic isn't the quality of its loan book, which is pretty good, but it's an old-fashioned bank run where deposits are fleeing, even after a bunch of larger banks deposited $30 billion in the darn thing to stop the run. So Yellen's thin red line means the bank probably gets saved, and maybe we've seen the end of the crisis? Is that how the stock surged nearly 30%? Now, again, remember, until today, this market reflected the sum of all fears zeitgeist about bank stocks. Suddenly, some of those fears vanish. We catch a breather. Bank stocks bounce from a short covering rally. Perhaps more than a short covering rally, though. Could it be the genuine bottom? But whoever wants to be caught saying that in the YouTube age, so no one has any surety. Short term.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.